If you ask the average person what a $10 million net worth looks like, they will describe a lifestyle. They will talk about Ferraris, mansions, and private jets. But if you ask a wealth manager what a 10 million net worth looks like, they will describe a spreadsheet. I have been a money manager, investor, and real estate broker for 30 years. I have looked under the hood of hundreds of multi-million dollar portfolios. And I can tell you that true wealth is incredibly boring. The people who actually have $10 million in the bank do not spend their days day trading crypto or buying flashy liabilities. They operate their money like a machine. Today, I am going to show you exactly what a real $10 million portfolio looks like. I am going to break down the exact asset allocation, and I am going to teach you the three-bucket formula, the exact framework the wealthy use to ensure they never run out of money, regardless of what the economy does. Whether you have $10,000 or $10 million, you need to structure your money using this exact blueprint. Let's look at the numbers. Before we look at the portfolio, we have to define what wealth actually is. In my 30 years, I have met plenty of people who make $1 million a year and have a net worth of zero. They have a $3 million house with a $2.5 million mortgage. They have 2 leased Porsches. They have a massive tax bill. If their income stops for 90 days, they are bankrupt. That is not wealth, that is high-income poverty. Real wealth is defined by one metric: the ability to sustain your lifestyle indefinitely without actively working. A real $10 million portfolio is designed to do 2 things: preserve the principal and generate enough passive cash flow to fund the lifestyle. To do this, the wealthy divide their net worth into 3 distinct categories. I call this the 3-bucket formula. If you mix these buckets up, you lose your money. If you structure them correctly, you become financially invincible. Let's break down exactly how a $10 million net worth is distributed across these 3 buckets. Bucket number 1, liquidity. This is the defensive bucket. Its only job is to protect you from forced liquidation. If the stock market crashes 30% or real estate values plummet, you never want to be forced to sell your assets at a loss just to pay your bills. In a $10 million portfolio, about 10% or $1 million sits in the liquidity bucket. This is cash in high-yield savings accounts, short-term treasury bills, and highly liquid municipal bonds. It generates a small return, maybe 4% or 5%, but return is not the goal. Safety is the goal. This $1 million guarantees that the investor can survive a 3 to 5 year economic depression without ever touching their core investments. Bucket number 2, income. This is the lifestyle bucket. Its job is to generate the cash flow that pays for the house, the cars, and the vacations. In a $10 million portfolio, about 40% or $4 million sits in the income bucket. This money is deployed into cash-flowing assets like commercial real estate and apartment syndications. This means private credit funds and dividend-paying blue-chip stocks. If this bucket yields a conservative 6% cash-on-cash return, that $4 million generates $240,000 a year in passive income. The investor lives on this $240,000 a year without ever touching the $4 million principal. Because much of this income comes from real estate depreciation and qualified dividends, it is highly tax efficient. Bucket number 3, growth. This is the legacy bucket. Its job is to outpace inflation and grow the overall net worth for the next generation. The remaining 50% or $5 million sits in the growth bucket. This money is invested in the S&P 500 growth stocks and perhaps a small allocation to venture capital. This bucket is volatile. It will go up 20% one year and down 15% the next. But the investor doesn't care because they don't need this money to live on. They have the liquidity bucket for emergencies and the income bucket for lifestyle. The growth bucket is left alone to compound for decades. When you structure your money using the 3-bucket formula, you remove emotion from investing. When the stock market crashes, the amateur panics and sells. The professional looks at their liquidity bucket, sees they have 3 years of cash. In fact, they use the cash from their income bucket to buy more assets in the growth bucket while they are on sale. This is how the rich get richer. You do not need $10 million to use this formula. If you have $100,000, the math is exactly the same. $10,000 in liquidity, $40,000 in income, $50,000 in growth. The percentages might shift slightly based on your age and risk tolerance, but the architecture remains the same. Stop throwing all your money into one bucket. Build a machine. Building a multi-million-dollar portfolio doesn't require a genius IQ or a secret stock tip. It requires discipline, time, and the correct architectural structure. I have built a robo-advisor platform designed to automate this exact wealth-building process. It allocates your capital intelligently and manages risk. Click the link in the description below to explore my robo-advisor and start structuring your wealth like a professional today. Stop acting like a consumer. Start acting like a fund manager. I'm JM. Thank you for watching, and I will see you in the next video. This is not financial advice. Do your own research. Subscribe to learn more wealth building formulas.